Joining us right now is Jeffrey Sherman. He's Deputy Chief Investment Officer at DoubleLine Capital. This is the house that are the experts on bonds, and that's why we've got him here. Jeffrey, it's really good to see you tonight. Thanks for joining us.
Yeah, thanks for having me, Becky.
I know it's never easy to figure out what's going on in the bond market. In fact, DoubleLine, I looked up your website today, and you guys talk about how no one can consistently predict changes on the level, direction, or term structure of interest rates. But you do say that when you're looking at the situation recently, this market was clearly oversold on a technical basis. You want to talk about what that looks like to you?
Yeah, well, if you look at the move up in yields we've seen, it really started with the front end of the yield curve, and it was the two-year rate that really started this new trajectory. And what happened is that after the July FOMC meeting, the market interpreted Chairman Powell's comments as being quite dovish, or at least they were close to peaking in the hiking cycle. And so you saw this big rally that transpired post-FOMC meeting back in July. And then all of a sudden you had Fed governors come out in droves early the next week saying, wait a second, there's a misinterpretation of what we're trying to do here. And what was happening is, as you know, that the Fed is trying to tighten policy. They're trying to rein in inflation. They're doing that through the interest rate policy as well as the unwind of their balance sheet via quantitative tightening. So if you put these two things together, that's the Fed's objective, to tighten policy. But if rates rally, if credit spreads tighten in, that creates a looser financial condition. It makes it easier for financial conditions. And so what happened is you saw the Fed governors come out in droves, say, no, you misinterpreted what we're trying to do. And since then, the bond market really listened. We had inflation data that spooked the rates market. We had also just some of the economic data, although it's been a mixed bag. Things like the labor market have been quite strong. And we know that the Fed sees the relationship between labor and inflation rates. And so put this all together, what happened is over the course of about 9 weeks or 8 weeks, we saw that the two-year Treasury rose almost 150 basis points. And what it did, it brought the rest of the Treasury curve with it. And it was really just nonstop selling of bonds over that period. And so just like in the stock market, when things get oversold, you're due for a slight rally. And so we saw that last week as well. And so we've seen a little bit of that rally. We've seen kind of consolidation across the tape right here. And right now, the Treasury market is looking for guidance. And as Mike said at the top of this segment, right now, it's all eyes on the jobs report this week and next week's inflation numbers. And if those do indeed deliver around expectations or don't significantly disappoint, I think in the short term, you're going to see yields press a little bit higher as the market continues to price in tighter Fed policy.
But if you look at oversold conditions, you're right. Yields have been much better behaved last week, starting into this week. We're looking at a different scenario. It just feels to me like there's not a lot of conviction from the market. You know, there's this sort of hope afloat that, okay, maybe the Fed is going to see things and maybe they're going to back off. But the Fed's certainly not sounding that out. All the Fed speakers this week have continued to be very hawkish.
Right. And I think once again, it's this idea of the market loosening the conditions. Now, we can argue that, yes, conditions are tighter than they were 2 months ago. But what you have is that a market that started to rally again. And a lot of this, I think, was driven by external factors. We know that the UK market sold off massively last week. It caused intervention by the BOE. It took a reversal of policy on the tax policy from the prime minister as well. Mm-hmm. And so what you've seen is that the U.S. markets moved a little bit in sympathy with the UK. If you look today, the UK is off commensurate with what we've seen in the U.S. market. So I think you're right that what we're trying to find is what that even keel is within the marketplace. But again, as you said, the Fed governors continue to spit the rhetoric that they want tighter policy. They're going to continue to be inflation fighters. And just look at the dot plots that were released at the FOMC meeting last week. What you have if you look at where the dots are, the bulk of the surveys from the various Fed governors is that policy rates should be 100 to 125 basis points higher than they are today. So that means the bond market needs to continue to tighten a little bit. So although I think we're very close to the end of this hiking cycle, and again, this is all going to be predicated on the growth and inflation data and specifically on the labor market. But if we're getting close to those late innings, what that means is that now it's getting to the point where the Treasury yields are a solid buy. And we're looking across the markets. What you're finding out there is that now that we've hit kind of these kind of levels we haven't seen in roughly 11 years or so, it's starting the time to really be able to leg into bonds. You can build high quality portfolios today that allow you to generate yields that are, let's say, roughly 6+%. And if you believe inflation, as we do, is going to come down next year, and maybe it's going to be elevated relative to Fed policy, but let's just say it prints around 4 to 4.5%. That gives you a significant real yield advantage. And so although there's choppiness ahead, we think there are some good opportunities within the bond market today.
Jeffrey, thank you very much. Jeffrey Sherman.